All right, so let's open this up for questions. Greg.
On here. It's a great session, and I really enjoyed the papers. I'd like to just ask Rodney a question. I think the identification strategy in your paper is really quite interesting. And this issue came up in both of the discussants' comments, too, at least indirectly. And one of the things I think that's interesting about this is I think it's sort of an unsettled question about to what extent are credit unions relationship lenders. And I was wondering if there's some way in this exercise that growth that we're talking about, is it relationship driven or transactions driven? And when I think of a transactions driven growth in lending, the thing that first comes to mind, and Gilda mentioned this, is indirect auto paper. That's about as transactional as you can get. It's also a very interesting business product because there's a contract between the financial institution and the auto dealer. Which auto dealers you're buying paper from, I'm sure people in this room know more than I do about that. But, and then this issue of cherry picking versus bottom feeding, all of that comes in. And I don't know that the data would allow you, however, to push that. But a credit union, buying indirect paper to grow their growth, to grow their loan portfolio is very different than organically growing.
So Greg, thanks. I guess to be brief, so by background, the identification that Greg means is the ability to make a causal statement with the data. And we did speak with the NCUA on this. They were very kind and read the paper and gave us some comments. And what we were able to document is that the marketing expenses of these institutions rose quite sharply once they got the designation. So they began to advertise a whole lot to tell people that, come and make a deposit, or you can get a car loan as well. So that's one way in which they try to grow the business. They kept most of these loans generally on balance sheet, so they weren't the securitizers. It's the non-banks who saw the competition and they stepped in and also competed for market share. And these are the guys that would sell it off. And that's sort of where the risks are in this case, I think.
How about any credit community bankers? Craig?
Craig Goodlock. I'm chairman and CEO of $80 million community bank in South Central Michigan. And following up on the same comments, I'm sure that I, along with the bank regulators, our hearts were warmed as we heard that community banks in that scenario did not chase after that business, but moved into other kinds of lending. And so, or in other kinds of products, rather than doing the 0.99, and I'm not going to write you at that either, Tim, for your auto loan. So what I'd be interested in research-wise is the effect on the diversification within the loan portfolio of those institutions then that changed, because we know, those of us who are community bankers, we know the angst with which regulators typically look at an increase in any kind of C&I lending. For me, in an ag district, my increase in dairy farm loans is very much anathema to a good way to grow your bank, those kinds of things. So what I'd be interested in is the effect on those that chose not to participate in that chasing after the lower rate, which you evidenced led to higher default rates and that kind of thing. So yay for us community bankers for being wise in our choices, but that leaves us with much more limited options. So some research that shows what was the net effect of being crammed into a smaller market or a smaller level of diversification within our portfolio would be of interest to me.
So I'll try to answer that briefly. What we did, so we don't have good data on the composition of the portfolio, but the data we have, we could document that the loans to assets ratio did increase. So they were lending less, but the composition of assets moved away from cash and bonds to actually making loans. And in many cases, the profitability of these banks rose as well. So so faced with more competition, it seemed that they found ways to cut costs as well.
Community bankers, please. And we'll come back to you academics, I guarantee.
Thank you very much. Chris Donnelly from Bank of the Prairie, $140 million community bank in Olathe, Kansas. And I think, I'm not sure who mentioned that some of us community bankers may get upset, and you did a wonderful job because that's exactly what we should be. For Rodney, more specifically on context, I think you used the words contracting and you used the words the community banks seceded from in your terminology. I want to make sure I get that correct. Did you do any work that, it's hard for me to understand or believe that a community bank would have raised the white flag. I don't think that's the case. I think it more comes back to my colleague who just spoke. The competition changed based on the outcome or the net outcome of whatever was being offered, the cost differentials, the cost in marketing, that change. I would see that would have driven that. Did you do any deep dive into that? Why the banks, you said seceded, which I don't think that would really be the case.
So I may have used a poor choice of words there. I guess I meant to say that they accommodated the entry, and partly they did that. My sense is if somebody enters a market where they're putting pricing pressure, then what we found is that these banks tended to move into markets where they could get a higher price. So what we found is that if the credit unions entered into the auto space where they have some specialized skill, then the community banks typically moved into the C&I space where the credit unions were less able to compete. So what the community banks try to do is to differentiate themselves by moving into markets where the competition was a little less.
Janet?
We're on.
You're on. Yeah.
Again, this is for Rodney. I've been in this business for 45 years, and we stopped making car loans in community banks, and mostly any bank, when deregulation happened, interest rate deregulation happened. And credit unions picked up that slack. So the idea of saying that, it appeared to me from your presentation that it wasn't that community banks accommodated the entry of the credit union. It's that they weren't making those loans at all anyway, and so the credit unions ended up making loans that would not otherwise have been made, evidenced by the B paper or the subprime paper and the default rates. That's not the business that community banks are in. Did you have any evidence that those loans were just not being made who was making those subprime loans, I guess is the question.
This is a fascinating point. One of the narratives about the crisis and the period afterwards was that the collapse in car sales and the slow growth came about because the consumers didn't want these loans. So their balance sheets were affected by the housing shock. And so folks just weren't trying to buy cars or weren't interested in credit. What I think one interpretation of the study is that once the NCUA allowed these entities to come in, the demand was there. Now, it may be that the banks had stepped out because of the risks. So I think a good way to answer you would be that perhaps the demand was there, the demand was not being met, and these institutions came in and filled that void in some sense.
Tim, if I may, just on that point, at the same time that the period of the study takes place, it's also a time where we are going through this very deep economic downturn. I know in our own balance sheet, we intentionally shifted the mix of our asset side. And for us, a lot of the funding, we simply took it from our investment portfolio that was out there, say at 200 million, brought it down to about 120 million, which is a huge decrease, and we put it into commercial real estate. We're not a heavy C&I lender, we're a commercial real estate lender, but it was an opportunity to find income opportunities when the investment portfolio, there was nothing to be had in the investment markets. So I think part of this, of the issue here too, is that it is for lending in the auto side. So there was some data supporting that, but at the same time there was this other factor taking place that those community banks that were out of the market We're shifting balance sheets, but for other reasons.
Okay, couple of my academic friends, and we only have 2 minutes. So Bob, can you go first, and then my colleague Alan will
Yeah,
wrap
quickly,
with you.
Bob DeYoung from the University of Kansas. I've long said that if you put a bunch of community bankers in a room for 15 minutes, they'll talk about two things, regulation and credit unions, and I'm glad to have more empirical evidence of that. I have a question about consumer activism here. It's nice to have point estimates of this when we have consumer scandals and then consumer activism. You found a positive relationship. I don't think anyone's really surprised by that, but we have some idea of the magnitude of it. I think you need to go further, though. You can't just stop there. I have two directions for you to go. One is, if banks do divest in the face of activism pressure, do the activists put their money back in the bank? I mean, the deal's a deal, right? I really doubt that they do. The second question, and I guess the bankers and the economists in the room will all want to know this. When these deposits flow out, how much does that really affect the cost of funding or the cost of capital at the bank? That's what really matters as far as the community bankers are concerned, or the big bankers are concerned.
So the thing with this is, this story is really about the depositors. So I really take your points. The main issue here is this is a finding to really show that for once now, people are reconnecting themselves with the understanding of the ultimate investments of their financial decisions, whether it be deposits, insurance products, everything else. Because this story is even happening in the pension industry. It happened in the Netherlands as well as New Zealand. After a major scandal, the public found out that the pension funds were investing in sin stocks, including cluster bombs and whatnot. Soon after public pressure, pension funds adopted negative screening strategies. So in general, this is simply to show that people out there do care, and they're reflecting their social values on their investment decisions. Now, when it comes to the banks, there's a lot of interesting nuances in this, because this is not the full story. This is an evolution. As time goes on, I imagine these stories being very different. Do people go back to the banks? Odds are they're not.
Why not?
And I'll continue to that, but going back to your point on how big are these effects? Dakota Access Pipeline works for my favor because this is the biggest one I've seen so far. When I mention these global scandals, typically on the first quarter when the scandal starts, you don't really see an effect. The next quarter, deposit growth goes down, and the quarter after, it disappears again. And we know that from traditional consumer literature in terms of scandals, product market behavior is really quick. There's a literature on forgetting CSR. We do tend to forget scandals, and that's what, when they're interviewing one of the biggest cooperative banks in Finland, they had a massive influx of depositors coming their way because Nordea Bank was heavily involved in Panama Leaks, the major tax evasion scenario. They were interviewing the Finnish cooperative executive, and he was very typical Finnish in the sense that we don't show emotions, laughter, or any other human emotions. He was, yeah, it's great. But these things never really last. And that's how it's been to date. In terms of economic magnitudes, I don't think we're really there yet. And I'm only showing the depositor side. There are some papers documenting banking morale. These scandals do have an effect on employees. And once I presented this last week in San Francisco, a person came to me and said he was involved with a bank in 2002, and protesters in front of the door had made the claim that your bank is investing in this environmentally damaging project, and he personally quit his job. So there are all kinds of stories happening in the background. I'm simply showing the depositor case.
Thank you, Mika. Obviously, this has great interest to many of you. We're going to have a short break here. I think this is one of the great benefits of this conference, to mix the groups, and so I encourage you to share your thoughts with the authors and vice versa.